Hello everyone, and welcome to our Mind the Expectation Gap webinar looking at governance issues for pension schemes. I'm Ian.Bell and I head up the pensions team here at RSM, and I'll be joined by my partner Gary.Grewal, who heads up our pensions team in the Central region, in presenting today's webinar. The starting point for today's session is to actually start to think about what governance actually means to you and to your trustee boards, because it's a term that's often used and it's certainly a term that the regulator uses frequently. But when it comes to defining what is good governance, is actually quite difficult to find a firm definition, and actually the term does mean different things to different people. In preparing for today's session, we asked the question, what does governance mean, to several trustee chairmen, and these are a sample of some of the responses that we received, and as you can see, they're all a bit different. Several mention qualified and engaged trustees as part of the board framework. Some of them mention timely decisions, how you go about achieving objectives, how you mitigate and manage obstacles that arise from time to time, how you ensure that members are receiving the right benefits at the right time, and also how you as a trustee board start to comply with the rules and processes and procedures of your scheme. Oversight mechanisms is something that's mentioned, how you comply with law and regulation. Interestingly, none of the chairmen actually mentioned the trust deed and actually how you comply with the terms of the trust deed. So what really is governance? And when is it actually classed as good? Now that's the purpose behind our expectation gap report and also today's session. So we'll be exploring just what really is governance, what it means to you and your board, and how you can go about improving it. Now the need for good governance applies to more than just the world of pensions. And in other sectors, particularly as we've got an example here, the corporate sector, there's also a drive to improve standards of governance currently. And the Waite's corporate governance principles for large private companies does provide us with other examples of how boards should be conducting their day-to-day business and how their oversight over large corporate businesses can actually be improved. And in terms of the pension scheme world, some of those principles equally can apply, and we'll be looking at examples of that later in today's session. Now, as I mentioned earlier, a definition of what is good governance is actually quite hard to find, and after some searching on the pension regulator's website, this is the definition that you will eventually come across, which, as you can see, is fairly high level and clear in terms of the current expectations of the regulator. But this is clearly an area where the regulator would like to see improvements in the future. And having just seen the response from the consultation exercise that the regulator ran during 2019, the response has just been released in February 2020. And some of the areas highlighted in terms of places where governance could be improved are as follows. Trustee knowledge and understanding requires an update, and that's something the regulator will be looking at during the course of this year. There will also be a new industry working group established to look at diversity and inclusion on trustee boards. And the regulator will also be looking at sole trusteeship and producing an industry code for how governance can be achieved when that particular model of trusteeship is used. And lastly, an area that the regulator is clearly concerned with is the subject of defined contribution, and particularly small defined contribution schemes or sections within hybrid schemes, where the regulator believes that the governance around those particular assets would be better achieved were the assets to be consolidated into a larger operation, perhaps a master trust or a larger DC trust. So the responses to that consultation have given us some indications of the direction of travel for trusteeship governance. But also there are other aspects at play here. And last year, in January last year, the Occupational Pension Schemes Governance Amendments regulations were published. Now those regulations were a response to IORP2, which was a European directive that was then put into UK legislation through those regulations. Now, IORP2 and the requirements do affect UK pension schemes, and they clearly establish the need to be able to operate an effective system of governance which includes internal controls. Since those regulations were published, the regulator has indicated that they'll be looking at the regulations and looking how best to adopt them within the UK. And what we expect is a new modular code, a new code of practice to be issued by the regulator within the next 12 months, probably during the course of this summer. This new modular code of practice will include details on how trustees can demonstrate an effective system of governance, written policies on key functions and outsourcing of activities which schemes must have in place, and those need to also be reviewed every 3 years. It will also include the subject of remuneration policies for trustees, and also requirements to document their own risk assessment of the system of governance being required every 3 years. And lastly, trustees will need a function which internally evaluates the adequacy and effectiveness of the system of governance. Importantly, the new code of practice will be proportionate. Now that will mean that larger schemes may need to make bigger and better improvements to their governance than smaller arrangements, and it will also mean where there are clearly greater governance budgets available at the larger scheme end of the market, there will likely be more use made of internal audit as part of that review of the adequacy and effectiveness of systems and governance in place. So with all of that in mind, RSM conducted a survey of almost 200 trustees towards the end of 2019 to see exactly what they felt about governance at the current time, what they perceived as best practice, and how those trustees went about monitoring the standards of governance within their own schemes. We were very pleased to see in the responses to our survey that we had a good spread in terms of scheme type between defined contribution, hybrid and defined benefit, also scheme size ranging from the very, very large to in fact the very small, and also a reasonable spread of respondents themselves and the roles that they play within their schemes, but the majority were trustees, pension managers or secretary to the trustees. So very knowledgeable in terms of their responses being made on governance related issues. So in today's session, we'll be asking the question, are trustee boards really investing in scheme governance? And how is risk prevention being prioritised? And we'll be looking at that question through 4 main agenda headings. Firstly, looking at whose role scheme governance is anyway, looking at the lines of defence that trustees can put in place to help them with governance, looking at risk registers, failing to plan is planning to fail, and lastly, looking at the subject of audit and how that can assist trustee boards in achieving good standards of governance. So firstly, whose role is it anyway when it comes to standards of governance within a pension scheme? When we asked that question of our survey respondents, I think these findings were actually quite worrying and, in my mind, probably actually appear in reverse order. Because clearly the most worrying thing is trustees, whilst they recognise that they themselves are the ones overall responsible for standards of good governance within their schemes, they are very reliant on advisors raising or not raising governance concerns in terms of their own assessment of how well they're doing from a governance perspective. Now, clearly, no one advisor will have a helicopter view of a pension arrangement, and for the trustees to be placing too much reliance on advisors is perhaps unfair, because they can't actually comment on a number of areas of a scheme that are actually outside of their remit. So I think that's worrying, that trustees perhaps place too much reliance on advisors. And at the other end of the scale, the formal independent review is not being used very often. Now, trustee boards very often operate in silos because the trustees sitting around a table will perhaps only be trustees on that particular scheme and won't have any experience of any other scheme or best practice that they've seen in operation elsewhere. So without some level of independent review commenting on standards of governance within a scheme, trustees aren't going to be able to improve what they do because they have no knowledge of what works well elsewhere and what they actually should be doing. So as I say, I think the responses here really are in reverse order to my mind, and actually trustees should be thinking about conducting independent reviews of their own standards, benchmarking their standards of governance as well against other similar arrangements, because that actually will mean that they can improve by learning from others, as opposed to working in that silo and placing too much reliance on advisors that may not be able to comment on all aspects of a scheme. And when asked which advisors help the trustee board the most, the actuary scored most highly in terms of trustees relying on them to assist with standards of governance. Now, I imagine any actuaries listening to this particular webinar would have some concerns with that expectation, in that they would only be able to help in their own areas of expertise. And whilst they attend most of the trustee board meetings, because they are a key advisor to the trustees, they're not going to be able to fill all the governance expectation gaps that the trustees may have. And I think, surprisingly as well from our survey, the least of the top 5 advisors was the independent professional trustee. Now, our expectation would be, maybe unfairly, but certainly something that should be discussed, is that a professional trustee with experience of looking at several trustee boards and experience gained over many years of trusteeship should be very well prepared to actually be able to assist trustee boards on standards of governance and to make sure that all areas are being considered and being considered in the right way. Because clearly, when trustees are advising or relying too much on advisors, there are the risks that actually some of that advice will fall between the gaps between advisors, and the trustees will be left shortchanged in terms of the support that they believe that they require to have a sound system of governance for their particular scheme. So if trustees shouldn't be placing all of their faith in advisors to assist them with their standards of governance, what should they be doing differently? How should they be probing into aspects of their scheme to make sure that things are being handled correctly? This is something that we'd like to look at now, and I'll hand over to my colleague, Gary.
Thanks, Ian. So it's quite clear from the results of the survey that Ian's presented that there is an expectation gap around governance and internal controls. So we're going to explore now how trustees can fill the expectation gap when we look at the lines of defence model. And this is a well-known model in the world of audit. Now, before we come on to the lines of defence model, we asked in our survey about whether trustees delve into the detail of internal controls, and also how confident do they feel that key internal controls that support the scheme are firstly in place and secondly are working. And 2 interesting findings emerge from the survey. So firstly, broadly half of the survey respondents, 48%, were completely confident that strong internal controls are in place and are working. and half appear to be relying on others. There's a clear expectation gap here. Then if we move on to the question of whether internal controls supporting the scheme are tested at all, then over half again do not test their internal controls regularly. Now, pulling these two findings together, there is a significant number of trustee boards who rely on others, for example the administrator, to tell them that their internal controls are robust and are working. However, the administrator would argue that it's not their job to report on all internal controls. And in many schemes, there is no evidence of regular testing of controls and reporting back the results to the board. Now, the pensions regulator is very clear in this area, and they would say, as they have done in Code of Practice 09 internal controls, that internal controls should be tested at least annually. That's the third circle from the left on the chart, which represents only 46% of survey respondents. And interestingly, in the survey, some respondents suggested that controls must be effective because no big issues arise in their scheme. However, to be honest, they must be the lucky ones. So we would suggest a rolling program of test, evidence, enhance, and repeat. That's the type of approach that we would suggest for all trustees. Now that said, this does beg the question as to what do the best run schemes do, and who can you rely on to do all this testing? And this is where the concept of assurance mapping comes into play. And assurance mapping essentially links assurance from a number of different sources to a scheme's risk, so that monitoring doesn't become a full-time job for the trustees. Now, assurance mapping links 4 lines of defence, which you'll see on the screen shortly, and it can be instrumental in recognising expectation gaps. The first line of defence is the governance structures and the controls which support the day-to-day operations, and they will be the responsibility of the management team, the pensions manager, the administrator, the actuary, and the accountant, etc. The second line of defence, to ensure strong governance and strong internal controls, is the board. And the board will provide effective oversight. They will obtain the right management information. They will ask the right questions. Now, certain elements of this oversight can be delegated to subcommittees, but the overall responsibility rests with the main board. The third line of defence can provide anything from a review of strategy to an independent assessment of the effectiveness of all internal controls. It can be a deep dive into areas which are wider than administration or finance, and this is a specialist resource. Now, the third line can be a risk officer in the larger schemes, it can be company internal audit, or it can be an appointed internal auditor. The third line of defence, importantly, can tell you if the first lines and the second lines of defence are working effectively. The fourth line of defence is your statutory auditor. Now, the statutory audit is largely compliance, although it can highlight areas which all other lines of defence can probe further. Now, often trustees don't see the difference between the third lines of defence and the fourth lines of defence. However, the third line of defence cannot carry out a statutory audit due to the significant conflict issues that can arise. That said, you can ask your scheme auditor to do more work in certain areas or extend the scope of the statutory audit, as many trustees do. In fact, our survey found that 2/3 of trustee boards asked their auditor to do more work in certain areas. However, there are restrictions on what can be done, and I'll come on to that later. So linking assurances across the 4 lines of defence will highlight issues around expectation gaps and reduce risks. I'd like to spend a minute or two on risk registers to highlight how they can be useful in improving scheme governance and reducing risks. Now on the screen you'll see an all too familiar statement, but let's look at the value of a risk register, which is the second line of defence in the model that I referred to earlier. So being the second line of defence, it's the responsibility of the trustee board. The issues we are all experiencing currently with the COVID-19 outbreak puts operational risk governance to the test. The COVID-19 issue was an unknown unknown, a risk which has come from a situation that was so unexpected that it would never be considered previously. That said, some of the key risks we are experiencing now as a result of COVID-19 do individually appear in many risk registers. Risks such as ensuring business continuity, an increase in cyber attacks, a rise in fraud from scammers, the risks of the failure of a pensioner payroll, the risks of reliance or over-reliance on key workers, the risks of corporate failure, for example. Now, I do see these risks on well-governed scheme risk registers. So for the current risks that we're facing, many trustees are looking to see what initially they have on their risk register relating to a significant disruption in day-to-day operations and reviewing the controls that they have in place, together with additional plans which are being implemented at the same time. The risks that I've just referred to should be rescored in the light of recent events, and importantly, confirmation is needed that the controls that support these risks are also working. This issue may well unearth expectation gaps. Now, our survey sets out what the best risk registers look like, and in summary, the best risk registers that we see are concise. They're split between defined benefit and defined contribution risks. All risks are allocated to individuals or third parties. The risk register is aligned as close as possible to the business plan. And the risk registers and the supporting controls are written so that the controls can and are capable of being tested. Coming back to the internal audit function, whether that's a company internal audit function or an appointed advisor, this role can be instrumental at making sure that you have an effective risk register, as internal audit can cover non-financial processes, for example, compliance with objectives, the quality of the trustee training, etc. Now, I want to spend a minute or two to give you examples of the difference between internal audit and the scheme auditor, and to flush out the expectation gap. So to recognise that expectation gap, we asked our survey respondents, which areas would you like to see your auditor do more work in? Top of the list was to help improve governance. Now, your scheme auditor needs to gain a good understanding of your scheme, and if it's possible with this knowledge, that the knowledge can be benchmarked against other schemes that they audit, then yes, auditors can be part of the solution to help you improve governance standards. Secondly, to help improve internal controls. Now, to be absolutely clear here, your scheme auditor will look at internal financial controls which support the numbers in your accounts. They will not look at all the internal controls and all the internal controls recorded in your risk register. That's a job for a specialist team, i.e. the internal auditor. Fifth on the list was a review of benefit calculations. To clarify here, your scheme auditor is not required to deep dive into the black box of the accuracy of benefit calculations. However, under a completely separate piece of work, a separate engagement letter, they can use their internal specialists to do this work for you, and I'd encourage that work to be done every 3 years or so. And also as previously mentioned, 37% of respondents wanted their auditors to help manage and report back on their risk register. As I've already alluded to, this is definitely a job for the internal auditor, not the statutory auditor. Now, we do see many schemes which will just not have the resources or the budgets to follow the 4 lines of defence model, in which case we would recommend that schemes spend more time to ensure that the 3 lines of defence are working effectively. For example, to ensure that trustees are receiving the right quality management information, and that there's strong oversight by the board, and there's better use of the scheme auditor with appropriate safeguards in place to prevent any conflicts of interest arising. The critical point that I will leave you with is not to fall into the expectation gap and assume that someone else is covering a governance area or a key risk, because the consequences of that, as we found in the survey, can be severe.
So I hope you found today's session useful, and it's given you some thoughts as to what you can do to develop and improve the governance and compliance within your pension scheme. Certainly our report highlighted that there is potentially some expectation gaps that exist in many trustee boards as to the reliance they're placing on advisors and the information they're being given in order to run their scheme. Trustees need to think about what they can be doing differently, when it's appropriate to rely on advisors, but also where it's appropriate to drill down further and ask those searching questions to make sure that their scheme is being run in the most effective and efficient manner. Certainly our report highlighted that trustees can be more proactive in this way and thereby make sure that their standards of governance are consistently improving as we head towards a new regime that the regulator will be introducing during the course of 2020 with its new modular code of practice. You can access our Mind the Expectation Gap report through our Preference Centre at the RSM website, the details being given on this slide. And if you have any questions, having heard our session today, or indeed having downloaded our report from our website, then please do not hesitate to contact either Gary or myself at the email addresses given here, and we'll get back to you as soon as we can. Thank you very much for joining us today. I hope you found the session useful. Thank you.